There's a real estate move called the 1031 exchange that lets ordinary landlords sell an investment property, roll every dollar of profit into a new one, and pay zero capital gains tax completely legally. And most real estate agents will never sit you down and walk you through exactly how it works. Here's the problem most people run into. You buy a rental property, it appreciates, and you decide to sell. The IRS is waiting. Federal capital gains tax, depreciation recapture, maybe state tax on top. Suddenly 20–30% of your profit is gone before you even reinvest it. A property that gained you $200,000 can hand $50,000 or more straight to the government. Most people just accept that. They think it's the cost of doing business. It isn't. There's a rule sitting in the tax code, named after its own section, that the wealthiest real estate investors in the country use over and over to avoid that bill entirely, and nobody ever explained it to you. It's called a 1031 exchange, named after Section 1031 of the tax code. Here's the plain English version. Normally, when you sell property for more than you paid, that profit is a taxable gain. But the IRS makes an exception if you don't actually take the money. Instead of cashing out, you exchange one investment property for another one of equal or greater value. On paper, the IRS treats it like you never sold at all, you just moved your investment from one building into a different one. No sale, no gain, no tax bill. That's the entire secret. You're not avoiding tax forever, you're deferring it, and for people who keep doing this, deferring it can mean never paying it at all. But here's where it gets interesting, the mechanics. Say you bought a rental duplex years ago for $200,000, and it's now worth $500,000. Normally, selling triggers tax on that $300,000 gain. With a 1031, you sell the duplex, and within 45 days you must identify a replacement property. Within 180 days, you must close on it. The money never touches your hands. It sits with a neutral third party called a qualified intermediary the entire time. You use that $500,000 to buy, say, a small apartment building worth $600,000. Because you followed the rules and reinvested equal or greater value, that $300,000 gain isn't taxed this year. It just carries forward into the new property. Do this again in 10 years, and again after that, and you can keep rolling gains forward property after property, decade after decade, and pay the tax only once, if ever, when your heirs eventually inherit it under a completely separate rule that can wipe the gain out entirely. So why haven't you heard of this? Because it's not a loophole for a random person selling a house they live in. Your personal home doesn't qualify. This is built for people who treat real estate as a business. Landlords, developers, family real estate offices. Your regular financial advisor rarely brings it up because it's not their transaction to manage. It's handled by real estate attorneys and intermediaries who specialize in it. It's quietly become one of the most common tools wealthy real estate families use to grow a portfolio without ever writing the IRS a check along the way. Now, it's not a free-for-all. The rules are strict, and the IRS is not lenient if you miss them. Miss the 45-day identification window by even one day, and the entire gain becomes taxable immediately. The replacement property has to be equal or greater in value, or you owe tax on the difference. And you cannot touch the sale proceeds yourself, even for a day, or the whole exchange is disqualified. This isn't a shady workaround either. Congress wrote this rule into the code on purpose to encourage people to keep reinvesting in property instead of cashing out. The IRS actually wants you to use it. So picture that $300,000 gain, deferred, then deferred again, compounding into bigger and bigger properties, tax-free the entire way. That's the quiet mechanism behind a lot of real estate fortunes you've heard about but never understood. But this isn't even the most powerful version of tax-deferred wealth building the ultra-wealthy use. There's a related move, this time inside a retirement account instead of a rental property, that can shelter even more. That's the next file.